Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. It is Monday, June 23rd. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money. We're getting you up to speed with just 1 hour before the closing bell rings on Wall Street. Breaking news, stocks just off the highs of the day. That's after Iran's retaliation appeared to be more restrained than anticipated. Iran launched multiple missiles against U.S. bases in Qatar, but Qatar's defense ministry says it intercepted them. In the wake of the violence, stocks rose. Oil prices slipped Monday after Iran attacked the U.S. military base in Qatar. That attack was in retaliation for U.S. military action on its nuclear facilities over the weekend. There is no word of supply disruption yet. Investors, though, we know, are watching the Strait of Hormuz oil supply route. We're going to explain why this area is so critical. And as the world focuses on Iran, Trump's one big beautiful bill is getting more expensive. There may be significant changes on the horizon for that legislation. With an increased eye on foreign affairs, we're going to explore what this means for investors and taxpayers. We've got 1 hour to go until the market close. Yahoo Finance's Julie Hyman and Nez Ferre with me, as well as Thomas Hayes. He is chairman and managing member of Great Hill Capital, all here with me to break down some of the moves we're seeing in today's action. Julie, we're going to start with you live from the floor of the New York Stock Exchange with an update on the markets.
Yeah, and as you mentioned, we're seeing stocks just off the highs of the session, and we keep seeing sort of unpredictable twists and turns in the conflict there in Iran. But then the market reaction also a little bit unpredictable, as we have seen. Now, as you mentioned, we had Iran then retaliating at U.S. assets in Qatar, but there are some market participants who have said it is not perhaps as severe, as widespread as had been anticipated. So that is what they're attributing the increase that we're seeing in stocks today to that. Everything, as we know, since this began, since Israel's strikes against Iran began, everything really flows from oil prices, right? We see the reaction in stocks sort of take their cue from oil because oil is the most directly affected asset by what's going on there. And then we're seeing stocks sort of react to that as well. Is this going to have an effect on prices? Is it going to have an effect on inflation, et cetera, down the line? So oil, too, we are seeing a big, deep drop in oil prices today. We haven't seen a drop like this at least since the retaliatory tariffs, the sort of worst-case tariffs, were announced in early April. So seeing a decline like that once again today as we see a worst-case scenario for oil prices going higher, at least for now, sort of being taken off of the table or given a lower likelihood on the part of investors. And then I know in terms of other assets that we're watching as well, Bitcoin taking off to the upside again. We had been seeing it not really react like so-called digital gold, right? And initially, when we had some of this conflict heating up, we saw Bitcoin pull back. Now it is higher again. And gold prices, too, haven't necessarily been acting as you might expect, perhaps because they've rallied already so much this year. We initially were seeing a little bit of softness in gold prices, people not looking to that as a source of safety or hedging in this environment, Josh. So it's been interesting to watch the various moves that weren't necessarily as you might have predicted.
All right, so that's the stock market. And Nez, what are the latest moves we're seeing with oil?
Yeah, Josh, and we are seeing that WTI and Brent crude are down 7%, more than 7%, with Brent around $71 per barrel and WTI around $68 per barrel. The market appears to be relieved that the world oil supply remains intact. Iran's retaliatory move that aim at U.S. base in Qatar was seen as a restrained measure. So up until this point, the oil market was really weighing the different scenarios with the outlook dependent on Iran's response. JP Morgan analyst said this morning that there was really limited regional appetite for a broader response. The key was whether Iran would close the Strait of Hormuz. That's the worst case scenario. That's where you would see forecasts for triple-digit prices. But even with the risk of supply, look, analysts are saying that time and again, there is enough oil. Remember that OPEC Plus has been increasing output in recent months. So much of Wall Street right now anticipates that Brent will be in the mid-60s range for the remainder of 2025 and $60 per barrel next year. That's assuming that the Middle East conflict risk premium dissipates by then.
All right, let's bring in here Thomas Hayes as well as chairman and managing member of Great Hill Capital here with us as well. Thomas, I want to bring you in here. I bet you, Tom, there are some viewers who are watching this and they're saying, hold on a second. So the U.S. strikes Iranian nuclear facilities over the weekend. President Trump is dropping 30,000-pound bombs.
Yeah.
Right? Then today, Iran fires missiles at a U.S. base in Qatar. And I'm looking at the popular averages, and you see green across the screen. That might be surprising to some people. Does it surprise you, Tom?
This is a case of sell the rumor, buy the news, okay? If the great Art Cashin used to say, you sell the risk of war, you buy the first attack. What you have here, though, and what we heard this afternoon from sources was that this was a call-in retaliation attack to save face. And once we knew the magnitude of the retaliation...
Meaning by that, do you mean that Iran was giving Qatar advance notice?
That's correct.
Yeah, right.
That's correct. It was advance notice. It was symbolic so they can go back to their people. We don't take anything, and then come to the table. So it's either going to be a negotiation or a regime change. We don't know yet. But what we do know is this is very, very constructive for the region. This has been a long time coming. They were completely decimated. It was completely by surprise over the weekend. There was no ambiguity about the message. You will not have nuclear weapons, and it would take them so long and so much money to rebuild. So the market loves this, and the Saudis are going to continue to pump. The Russians are going to continue to pump to avoid sanctions. So oil prices stay low. That's the key thing for President Trump. That keeps inflation lowered, so we can get some of these tax cuts done, and we can deal with the big, beautiful bill.
So Julie, I want to bring you back here as well, because what Tom is pointing out here, that is the interpretation today, that the market's thinking, you know what, the U.S. hit Iran and nuclear facilities over the weekend. Now Iran does hit back against the U.S. base in Qatar, but it's kind of limited. It's contained. The New York Times is actually reporting Iran gave Qatar advance notice of the attack as a way to minimize casualties, they say, citing sources. So the market thinks, here's the interpretation, hey, this is actually de-escalation. This is giving everybody an exit ramp, and that helps explain why the major averages are in the green. What do you make of that?
Yeah, I mean, I would say also the thing that I would add is even if we had seen that retaliation, again, it all flows from oil, and we've certainly seen geopolitical conflicts before that have been severe that do not have a sustained effect on the market. Look at Russia's invasion of Ukraine, which initially did have an effect on oil prices, had an effect on natural gas. That abated over time. It also had an effect on stocks initially that abated over time. So it really depends, right? There's not one playbook for geopolitics and for conflict, but we do tend to see that stocks, at least equities, don't necessarily see a longer-term hit from these kinds of activities. The other thing I would point out is that things could still change, right? We don't want people to think, okay, the coast is clear and that's it, because now there is still the specter, the possibility that Iran could limit oil flows through the Strait of Hormuz. Now, the oil analysts we've talked to, Josh, have said that they don't necessarily think that's likely. It's not necessarily the base case, but if they do that, it could see, then we could see another effect on oil prices to the upside. I mean, Goldman Sachs was out with a note this morning saying the upside potential would be $110 a barrel. Again, it's not necessarily their base case, but it's not something that investors should entirely take off the table here. We are still in a potentially volatile situation.
Inez, I want to come back to you here. I'm looking at WTI, Inez. We're down more than 7% right now. We're back to 68.6. What do you chalk that up to, Inez? You study these markets so closely. Is it that the markets are saying, yes, actually what we're seeing here in the Middle East, the market thinks is the beginning of de-escalation? Is it President Trump's post this morning, Inez? You saw that on social media saying, hey, drill, baby, drill. I meant it. I want to see it. Let's make it happen. Is it all those things?
I mean, look, it could be all of those things. But as far as that post that President Trump put on social media, oil producers are not necessarily going to drill more because of that. They will drill what's better for their bottom line. I actually spoke to one analyst that said, look, you need to see WTI at sustained levels above $70 per barrel in order for shale producers to drill a new well. And we're seeing it at $68 per barrel. But so much of this has to do with really the oil supply and the fact that Wall Street believes that there is enough oil out there. You do have spare capacity. And I do want to point out one thing. You are seeing right now Brent at just above $71 per barrel. Take a look at this 1 month chart. This is around just before Israel struck Iran. So we are about $2 away from the closing price on the day before Israel did that first strike against Iran. Josh.
All right. Thank you, Inez.
Thank you.
Well, while the world's attention is on Iran, President Trump's one big, beautiful bill is getting more expensive. For more on the upcoming tax bill decision, let's welcome in here Yahoo Finance's Ben Werschel. Ben.
Yeah, hey Josh. So nothing can slow down the Republican push for tax cuts. It appears what we had over the last few days is a series of developments, clearly overshadowed by what was happening in Iran, on this big beautiful bill that changed the shape of it and taught us more about it. The first one actually came on Saturday evening, at about the same time as the attacks, which was a new report from the Joint Committee on Taxation that gave us a new price tag for this overall package. It's now expected, once you untangle some accounting maneuvers that the Senate is doing, that this bill is going to cost $4.2 trillion. It's going to add that to the debt over the next decade. That's a higher price tag than we've had before, and is already getting pushback from fiscal hawks who are already kind of wary of this bill and are now re-upping their criticisms of it. Whether they vote no in the end remains to be seen. The second is the what's called a bird bath. The Senate parliamentarian is going through the bill line by line to make sure it appeals to Senate rules. And she's striking a number of things out. We've already seen cuts to a provision that would have limited funding for the Consumer Financial Protection Bureau, cutting that out, changes to a lot of tax savings too, as well as the food stamp program. So those are significant changes, and we'll change the price tag further. The couple signposts for folks to watch in the couple of days. The Senate is pushing for this, to vote on this, to get this through the Senate by the end of the week. The first shoe to drop could happen this afternoon or tomorrow morning. That's the parliamentarian going over the Senate Finance Committee's portion. These are the big ticket items. These are the tax portion. These are the Medicaid cuts. These are the clean energy credits. All of these things are going to be under review. So there could be a lot of headlines either tonight or tomorrow morning about whether those are changing or staying in the bill. And then, of course, we're heading towards a vote by the end of the week. John Thune is the Senate Majority Leader, and he talked about how when the senators are back today, and they're not leaving, in his words, until they pass this. And he suggested the first votes could start on Thursday and then stretch for as long after that as they needed. So a lot of focus, obviously, on Iran, but the Capitol Hill is clearly focused on getting this bill to the finish line for their ultimate goal of July 4th to the president's desk.
All right, Ben, thank you. Appreciate it. Tom, very quickly, I just want your take here. This big, beautiful bill, the tax bill. I'm just curious, as a money manager, as a guy who has to think through what to buy and what to sell, how do you think through that?
Yeah, I think, number one, what's underreported is what the bill unfunds. And if you look at what it unfunds, and a lot of climate stuff is taken out, which is why Elon Musk wasn't happy with the bill, it's more responsible than advertised. It's not perfect. The only way we're going to get out of 120% debt to GDP is through growth. And we need tax cuts. We need deregulation. That is happening. And things are constructive. I love the low bar that is set going into earnings season. They took down earnings from 9.3% earnings growth to 4.9.
Yep.
So there's a lot of global liquidity. You know, people wonder, like, why have international stocks outperformed? It's money goes where it's treated best. There are 15 cuts around the world last month alone, okay, which is the biggest amount since during COVID. And zero from the U.S. So I think what you're going to see is you start to see some division here. Waller. You had Goolsbee today. You had Bowman today, now coming out kind of against Powell. I think the Fed wants to be more dovish. I think global M2 money supply, you look, is at record highs after flatlining since 2022. So there's a lot to be constructive about here. A lot of growth coming, a lot of deregulatory policies. Animal spirits want to go. So we got through kind of the worst of the tariff. We got through the kind of the worst of the geopolitical here over the weekend. Now it's like, companies are on track. Animal spirits are coming back.
Julie, bring me back here. I'm listening to Tom.
Hey,
he puts
Tom,
me in a good mood. What do you think?
Well, Tom is an optimist, in my experience. I'm curious about this tax bill, though. It feels like kind of a non-event at this point, unless, as you said, you're in, if you're in solar stocks, it does not feel like a non-event. But sort of overall to the market, it feels like less of a boost than it was. It's more if it didn't happen, that would be sort of catastrophe. It happening is kind of a shrug at this point, no?
Yeah.
A shrug, Tom. You agree with that? Is it a shrug for the market, the tax bill?
I think at this point, I think Julie's right. And as far as being optimistic, 70% of the time you're right. That's what happens with the stock market. Haven't met too many wealthy pessimists, so it's paid to look at the bright side of things. And you know what? Based on the data right now, there's a lot to be constructive about.
All right, let's bring in another market strategist for his thoughts here on what all this means for your portfolio. Let's welcome in Ed Yardeni, president of Yardeni Research. Ed, it is great to see you as always. You are a market strategist, Ed. You're an economist. I also know you're a student of geopolitics and geostrategy. Yeah. I know that, Ed, because I read your research every morning. So first of all, I'll get your take on what we're seeing in the Middle East. One interpretation here, Ed, is that the U.S. did hit Iranian nuclear facilities over the weekend, of course. Now, today, Iran fires missiles at a U.S. base in Qatar. The market, perhaps, is thinking, you know what, that was a relatively contained, limited strike, and perhaps what this is actually is a sign of de-escalation. Everybody still has an exit ramp. Maybe that explains why there's green across my screen here. But what do you think, Ed?
Yeah, look, the leaders of Iran, the mullahs, the supreme leader, they may be fanatics, but they're not crazy. They've got to realize that they're basically on the short end of this whole development. They never expected to see Israel basically wipe out their proxies in Gaza, in Lebanon, in Syria. And so they've got no friends that have encircled Israel anymore. And it doesn't look like China, Russia, North Korea are kind of jumping in to help them out. So they are kind of all alone here without a defense system anymore, where the Israelis can continue to pound them and the Americans can come in willy-nilly and do the same with bigger ordnance. So I think that they are going to sue for peace. I don't know how exactly they do it, but I think, they've retaliated, so check that box. And now I suspect there'll be some quiet discussions going on between the United States and Iran, either directly or indirectly, that will lead to a end to this war and a recognition by Iran that they can't have nuclear weapons.
Ed, did what you saw this weekend and what you saw today, did it in any way, Ed, impact or affect your general market outlook?
Not at all. As a matter of fact, I kind of reconfirmed that I'm still looking for 6,500 by the end of the year. I still think that we're in sort of a roaring 2020s scenario. So by the end of the decade, I think we'll get to 10,000. I think we're in a bull market. The bull market started October of 2022, and I think it has a ways to go. I think it's going to have to be driven by earnings because valuations are back to being rather high. But I do think that the outlook for earnings is actually pretty positive, because I still believe that productivity will continue to grow at a faster pace.
Anything, Tom, you're listening to Dr. Ed there, anything you say you agree with, disagree with, what do you think?
I agree with Ed. We had dinner down in Miami. Ed, tell me, look, forward multiples, 21 times. I'm optimistic. I know that this market's going to push to new highs this summer. Do you think the sell side consensus is too low on earnings, and that's why this can push higher, even though we've got a 21, 22 times forward?
I think there's the strategists, and then there's the analyst consensus, and the analysts are actually fairly optimistic, right? I mean, they're looking for $300 a share next year. Yeah. This year, last I saw, they were around $260 a share. Those are kind of exactly the kind of numbers we're anticipating. Yep. And the problem with $300 a share is you put a 20 multiple on that at the end of this year, and you get 6,000.
Right.
You really have to, stretch the valuation multiples to get up even to 6,500. But I think we're going to do that. I think we'll do that with the Magnificent Seven. Maybe there'll be a few more stocks that are kind of viewed as those kind of unique companies that will have very high valuation multiples. And as you know, the Magnificent Seven still account for about 30% of the S&P 500. Take out the Magnificent Seven, and you got something maybe a little bit more realistic, 18, which is not exactly dirt cheap either, but at least it gives you some opportunity for upside on the PE. But I think it's going to have to be earnings.
Yeah. So your base case is multiple expansion into year end, and there's no accounting for animal spirits coming back now that some of the uncertainty is in the rearview mirror, and estimates going up into year end. That's not in your calculus at present, but you're open to it. Is that a fair characterization?
Well, I would say that I'm very optimistic on earnings, and I think the analysts were starting to cut back their expectations, and in recent weeks they've started to become more optimistic again, and they've been increasing. I look at forward earnings, which is analyst consensus expectations for this year and next year on a time-weighted average basis, and it's at an all-time record high, and I think it will head up to 300 by the end of the year. And I think there's still some room for the valuation multiple to get somewhat higher, maybe up to 22 or so, and 22 times 300 gets you pretty close to 6,500 by year end, and then I think next year we'll be looking at something like 7,000 on led by earnings again.
Yep.
Julie, I want to bring you in here as well. So Ed is constructive on the market. In part, I think, Julie, he's sounding some of the themes we've heard from other folks who are equally constructive. It comes down to the economy. Many thinking, this economy surprised them with its health and its resilience.
Yeah, I think it surprised many people with its health and resilience, but I don't know. I think, are tariffs gone? Are they just not going to have any effect? Are companies not going to pass on any of those costs to consumers? Even if they do, yes, you could still have a scenario where you see the earnings outcome that is being described, but that's not to say that there is an environment here where there is no risk whatsoever of potential weakness or consumers continuing to be concerned.
Yeah.
How do you think about that, Ed? And Julie's right to bring that up. President Trump, it does seem, has backed off sort of the maximalist position there, Ed, on tariffs, but I am curious how both as a strategist and an economist you think through that.
Well, I kind of agree that, tariffs haven't gone. It's still an issue. It's going to probably get resolved over the next few months. I think the market is looking past the tariffs and concluding that the economy will continue to grow. I think it really is all about the resilience of the economy. For the past 3 years, we've had probably the most widely anticipated recession of all times that didn't happen. And then over the past few months, we've had the similar kind of situation where suddenly people were convinced that Trump tariff turmoil, as I call it, was going to cause a recession. And now that kind of concern has come down. And then we didn't really even get much of a panic reaction from what's been going on in the Middle East. If anything, it seems like the way things are going, the market's actually pretty satisfied that things will be all right, that it'll work out, and it might work out much better than anyone possibly anticipated. But resilience is really what's driving the market. It's a surprise resilience of the economy, and what that means is earnings have been better than expected by most investors anyways. And it also means that investors are increasingly willing to pay a higher multiple. If you thought there was going to be a recession like in 3 months, you certainly wouldn't want to pay these kind of valuation multiples. But if you become more and more convinced that this thing could last maybe through the end of the decade, then I think you're going to see that supports valuation multiples.
Ed, we are always lucky to have you on the show. Thank you for joining us, sir.
My pleasure.
And we are just getting started here on Market Domination. Coming up, Tesla stock popped as its robo-taxi event kicked off on Sunday. We're going to check in on the EV maker as well as some of our other top trending tickers later in the hour. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves to your portfolio. Stay tuned. Much more market domination. That's still to come. Now time for some of today's trending tickers. Julie Hyman and Thomas Hayes here with me to discuss. And some of the names we are watching are Tesla and Stellantis. We're going to start off here with Tesla, which is seeing big gains today after the unveiling of the company's robo-taxi service yesterday. The electric vehicle manufacturer launching the program with 20 cars that will still be occupied by employees to monitor, with each ride costing a flat fee of $4.20. CEO Elon Musk says that Tesla will likely expand the service based on its performance. Tom, what do you make of it?
Well, it's like a magician. Look over here. It's the illusion. I mean, the car business has deteriorated since his involvement in politics. However, if he's right, I just saw a quote from him. We expect hundreds of thousands of robo-taxis, if not millions, by the end of the year. That is a bold statement. If he gets anywhere close to it, maybe today's move is an underestimation. However, if we look at the car business, that's another story. And I think it's a trade-off. You're always betting when you pay the valuation that you do for Tesla. You're always betting on the man. And he's delivered for many, many years, and the followers want to continue to bet on him. So this is a step in the right direction. Robo-taxis could be game-changing, but it remains to be seen. If you have drivers in the car, it's not a robo-taxi.
Julie, bring you in here. I mean, as Tom says, you bet on the man, right? This is what Musk says. Musk has said this. If you own my stock, it's because you are a long-term believer in my vision for autonomy and robots, Julie.
Right. Of course. I've said this for a long time. Tesla is a faith-based stock, right? People are not buying it because of what is happening today or what happened yesterday. They're buying it because what they think is going to happen, what they believe is going to happen tomorrow and in the years to come. I mean, our friend Dan Ives over at Wedbush is a prime example of that. He was there. Him being a big Tesla booster, no surprise, he was there over the weekend, and he talked again about the $1 trillion autonomous possibility, the journey, as he calls it, that is not just to do with the robo-taxis, but to do with the AI sort of thesis that he has around the stock overall. I thought it was interesting. Our friend Jordan Klein over at Mizuho is a desk analyst over there, and he said, you know, the people that they sent to do this test were people that they knew were Tesla supporters. And even given that, Bloomberg is reporting that some of those influencers, some of those Tesla folks did point out that the test didn't go without flaws, right? They pointed out that, you know, some of the cars went above the speed limit, which maybe isn't a big deal, but they pointed out maybe some turns that didn't make sense. There was one group of folks in a car reportedly that tried to push the button to ask it to stop. And I guess eventually it stopped in the middle of the road. So there are still some bugs that they're working out. It's not like that this thing is, you know, flawless and they're going to be rolling it out to a bigger area and to other cities right away. That said, a lot of analysts did say that this went a little bit better than expected, was at least neutral.
Yeah, not to mention the competition as well. You got Waymo, you got Amazon, Zoox, but to Tom's point, stocks tacking on about 8% in today's trade. All right, here's another one we got to check out. Stellantis' new CEO, Antonio Filosa, stepping into his role today by avoiding any major changes to the senior management team. Analyst at Jefferies saying that revamping Stellantis may not be a full-time job for Filosa, who is also still maintaining his role as head of the North American market. Shares of that automaker have been dropping since the market opened. The stock price is overall down about 10% since announcing Filosa's appointment as CEO. This one is interesting, Tom. You did have, all right, so we reorganized management. The CEO is part of this 13-member senior leadership team at the company. You know, Bloomberg does know the new CEO here, he's got a lot on his plate. I mean, halting a sales slide in the U.S., they talk about an aging lineup, model delays, pricing blunders, but what do you make of it?
I think rule number one is they should probably get rid of the other 12 managers. Then they could be lean and more efficient. Look, that's a tough business. We are in the, we have a business that supplies the sealing systems around the windows, the fluid transfer systems. I'd rather be an arms dealer because what's going to happen is Besson's going to be successful with bringing rates down modestly this summer. That's going to bring down financing rates for cars, but it's going to be a race to the bottom. There's going to be a huge amount of supply. Their margins are going to continue to go down, the OEMs. The suppliers of the parts are going to be the ones that do well because we've got average car on the road is 13.5 years. There's a huge pent-up replacement cycle. We just need to see the incentives and we need to see the financing rates come down, and they're going to start to do huge, huge volumes. The question is, what are the margins of the Stellantis, the Ford, and the GM going to be? I don't want to be in that business.
All right, Julie, bringing you back in here. I hope Tom is right that those rates are coming down, because I would be certainly interested in making a purchase, as you well know, my friend, if they did. But Stellantis, your thoughts?
I know. I mean, if you look at how Stellantis has done over the past 12 months, I'm just looking at the numbers here. They're down like 55%, the U.S. shares. And we know that the car business overall has been challenged as of late, right? But compare that with GM. Little changed over the past year. Ford is down about 12%. So we see there, obviously, that Stellantis has been underperforming its peers. It's not just sort of struggling in what is a difficult car market. It's doing worse. And I don't know that we know yet from Filosa what those steps are going to be to turn it around.
We do not. But for now, we move on. Some news on the weight loss front. Amgen revealing plans for phase 3 of its highly anticipated GLP-1 Maritide. For more, we're bringing in here Yahoo Finance senior health reporter Anjali Kamlani. Anj.
That's right. So we got news from Amgen today, which is at the American Diabetes Association conference. That's why you're getting a flood of GLP-1 news today. And their latest is that they've started enrolling for their phase 3 of Maritide. Now, we remember this drug is their weight loss drug that is going to enter a market that is competing with Eli Lilly and Novo Nordisk. Currently, the drug has about 20% weight loss for those without diabetes and 17%. And as you already can tell with those numbers, that's a little bit lower than what the competition on the market is, Lilly being the lead with 24%. And so that's the market that's going to enter in. We do know that they have changed how they're doing the dosing for phase 3, looking at a step up or a 3-step up. And they did this in a phase 1 trial to kind of figure out, because they were having some issues with tolerability, not abnormal for these kinds of drugs, but of course, trying to figure out how to make it more appealing for patients, and this is why. So looking at that, they are going to start off at 21 milligrams and then move all the way up potentially to 350 milligrams. And that's sort of what we got from the company today, and we'll just have to wait and see how that phase 3 trial pans out, and then eventually when they do get to market.
And Anj, what exactly are investors looking for from Amgen? I mean, we know like GLP-1s are the hot thing. Weight loss drugs are such an area of interest for investors. And so you would think there would be all this enthusiasm here. But what specifically do they expect and do they want from Amgen to try to meet some of those other competitors?
Yeah, so the tolerability was one part of it, but they've also kind of just been sort of mixed bag on the stock itself, wondering where Amgen gets to play. It's important to remember that this is a differentiated drug because it is going to be a once a month injectable rather than the current weekly. And so that really reduces the burden on patients. And it's a reason why a Jefferies analyst was saying earlier that it looks like really this could be the play. Amgen Amgen remains debated by investors, right? But they still get pretty good feedback from the doctors, and that's the part that they have to look at, is that what are the doctors going to be prescribing? Because at the end of the day, that's where the pickup is for the medication. And so if doctors like it, then they're going to be really more likely to prescribe it. And in addition to that, Amgen is also studying the drug for quarterly maintenance. They've noted that the drug has sort of a lack of plateauing at the end of the current study, and they're going to look and see whether or not more weight loss is possible. So it could still end up being competitive, is what they think. So there's a lot to really wait and see on this drug right now.
All right, thank you, Anj. Appreciate it. Coming up, it is the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, much more market domination. That's still to come. What's a big, noisy universe of stocks out there? Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio. Today we're dissecting valuations, and I'm here with Tom Hayes, Great Hill Capital Chairman and Managing Member. You're bullish on Albemarle, Tom, so that's where we're going to start. We're going to go through the reasons why you like this name, which, by the way, it hasn't had kind of rough, year to date. It's been kind of rough, but we're going to walk through why you say this one's a buy. So let's go through the points. First point, huge huge operating leverage.
Yeah, this is a big deal. So they're a lithium producer. They're the lowest cost. They're one of the largest lithium producers. So right now, lithium prices go in 5 to 8 year cycles. We're at the trough of the cycle. It kind of fell into the EV narrative that people don't want EVs anymore, but that's really not the story here. As the price turns, as it does every 5 to 8 years, even pre-EVs, we're talking 40 years, this has been going every 5 to 8 years, the cycle. The amount of operating leverage that Albemarle has to benefit as prices go up is astounding. And in the short term, they've got ample liquidity to ride through that trough while their competitors will fall away at the wayside.
All right, second reason, you say this one's a buy, demand growth.
Yeah, so the EV story is predominantly a China story. China has 60% of the EV market. They're growing in leaps and bounds. This is an unnatural, subsidized market that's going to continue. It's an initiative of the government. U.S., by contrast, only has 10% of the EV market. But that's not the source of the actual growth for lithium. It is energy storage systems, okay? That's expected to have demand from 1.2 million metric tons to 3.2 million metric tons by 2030. Albemarle is going to be the key beneficiary of that growth.
Final reason, you say to pile into this one, dividend aristocrat.
Yeah, they've been raising the dividend every single year for 30 years plus. That makes them a dividend aristocrat. Stable balance sheet, $3.1 billion of liquidity. The market is expected to rebalance by 2026. And when they rebalance, it's the stock is down materially. We do turnarounds. My nickname is Turnaround Tom. So this is a 3 to 5 year play. This stock from current levels, it's trading around $55, $60, could go back up to $150 once the cycle returns and the operating leverage benefits. And you're locking in a yield at current low levels, so you're getting a high yield on the stock. It's below 3%, but not only will you lock in that high yield, but they'll continue to increase the dividend every single year, similar to what Buffett did with Coca-Cola in 1989, and he gets more dividends than his basis every single year, 20, 30 years later.
All right, turn around, Tom, but here's the thing. So viewers are watching this right now.
Yeah.
Before they commit capital, what are some downside risks they need to think about here?
Yeah, I think the biggest downside risk would be if the Chinese government did an about-face and they said, we're no longer going to subsidize our green initiative. It's a very low probability, but some of that demand is from the unnatural subsidies in that government initiative. That's going to continue, and we think it's part of their domestic consumption plan for 2030. They want 70% internal domestic consumption. So I don't see that happening, but that would be a risk.
All right, so that's your buy. Let's move to the name you don't like, and I like this one. I like this one because people have very strong feelings about it. Palantir, not a fan. Let's go through these reasons as well. Stocks overvalued.
Yeah, look, it's $324 billion market cap on $3.9 billion of sales, 83 times sales, 200-something times earnings. So you're effectively, look, if you believe in Palantir, and they certainly do have a defensible moat, they're going to do great things. The question is, how much of those great things that they're going to do over the next decade are you already paying for today? Current valuations, you would have to grow revenue at a 50% compound annual growth rate for the next 10 years to justify the current valuation.
All right, bullet point number 2. So it's too rich, the second reason.
Yeah, so 50% of the stock, a little more than that, is owned by retail investors. If that sentiment turns, like we saw with the meme stocks, whether it was AMC, high valuation, not really on the basis of current fundamentals, GameStop, et cetera, when they fall fast. When they exit all at once, so you have some risk there.
And then final point here, the reason you'd say avoid it, aggressive competition.
Yeah, there's no question. You've got Databricks, you've got Microsoft, you've got AWS, you've got all these companies coming into the arena. I would say another red flag has been the insider selling. $125 million in the last 30 days alone. The chief technology officer is selling like his pants are on fire. I mean, unless the guy wants to buy a $120 million house, I don't know what he needs all that cash for. So it tells me maybe it's gotten a little ahead of itself. The other thing I don't like is that they've diluted their owners and increased the share count by 4x over the last 6 years. So even even if they continue to do that, if they keep issuing stocks to management in abundant amounts, what is your slice of the pie going to look like if you buy today and they 4x the share count again over the next 5 to 6 years?
And before turnaround time, I let you go.
Yeah.
The last thing I need to know, though, where could you be wrong? What are some upside risks I need to think about?
I think the biggest risk, they certainly have a quality product. It's a defensible product. They have a moat around their product. The biggest risk would be is if the Defense Department decided to double government spending on defense, which, given the budget talks, given the initiative of this administration, is probably a lower probability, but not a non-existent probability with everything we've seen over the weekend. Nothing is out of the question, in which case Palantir would be a beneficiary. Government spending would go up. Their contracts would probably go up.
And we should know the stock has been a monster, Tom.
Yeah.
It's up about 85% this year
Yeah.
already. It was up around, last I checked, 480% over the past 12 months. What a run. But there it is. Portfolio recommendations: buy Albemarle, avoid Palantir. Thank you so much, Tom. Thank you for the viewers as well for watching Goodbye or Goodbye. More market domination right on this side.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Over the weekend, Iran's parliament reportedly pushed the nation to close the Strait of Hormuz. And while there has yet to be a major disruption to the global oil supply, any sort of closing of that waterway could spike prices around the world. About 20% of global oil and gas flows through that narrow passageway connecting the Persian Gulf to the rest of the globe. According to the U.S. Energy Information Administration, about 20 million barrels of oil, about 1/5 of daily global production, flow through the strait every day. Analysts at J.P. Morgan Chase have called a blockage there a worst-case scenario and suggested the result could be global oil prices reaching $120 a barrel, pushing inflation in the U.S. to 5%. Eurasia Group founder and president Ian Bremmer joined our opening bid this morning to discuss the impact, but says there may not be a serious threat from military attacks.
It's one of the most important transit points, bottlenecks for global energy and a lot of other shipping, chemicals, manufacturing, trade, and the rest. There are already a number of oil tankers that have changed their transit plans away from the straits just in the last 24 hours, going around the Cape of Good Hope. It's a lot more expensive. It takes a lot more time. But there's not a belief that it's going to be disrupted by military attacks.
The energy issue is clearly top of mind for President Trump, who offered 2 oil-focused posts on Monday morning. One to the Department of Energy saying, drill, baby, drill, and another told oil companies to keep prices down, as he will be watching. For more on what's next and the key policy decisions at hand, let's welcome in here Will Todman, CSIS, Chief of Staff, Geopolitics and Foreign Policy Department, and Senior Fellow of the Middle East Program. Will, it is good to see you. So, this weekend, of course, the U.S. strikes Iranian nuclear facilities. Today, Iran strikes back. They fire missiles at a U.S. base in Qatar. What's interesting, Will, is how the markets seem to be taking this all in stride, with the Dow up about 300 points right now. I'm curious what you make of that, whether the market should be taking this all in stride, Will.
There have been several signs that actually we might be heading towards de-escalation. That might seem counterintuitive because Iran has just conducted a historic first by firing missiles at the Al Udeid base in Qatar. For the first time, we saw images of missiles flying over the Doha skyline. But actually, they seem to have given advance warning. And so I don't think these strikes were necessarily intended to result in a lot of casualties. So this is following a playbook that Iran first did in 2020 after the Trump administration then ordered the assassination of Qasem Soleimani, a senior Iranian general. And they did the same. They fired missiles, but they gave advance warning, which meant that they did not actually result in any U.S. deaths. So for Iran,
I'm sorry, go ahead, Will. Go ahead.
No, I was just saying that this is an opportunity for Iran to show that it has responded to its domestic audience, but ultimately, really without escalating. They have not taken any of the more serious options they could have taken, like closing the Strait of Hormuz, as you were just discussing.
And to your point, Will, I was just going to add that the New York Times, citing 3 Iranian officials familiar with the plans, did say Iran gave advance notice the attacks were coming as a way to minimize casualties. I guess my question, Will, is what do you think now happens next?
So this could follow the same playbook from 2020. The U.S. could choose not to really respond and not to retaliate. And then we enter into a period of renewed negotiations, or at least a winding down of this conflict. But there are several wildcards here. The first is that Israel is now a critical actor in this, and it may decide that it has not yet achieved its aims, and that it wants to keep going with the strikes that it's conducting on Iran. And that might force Iran's hand and make it feel like it has to continue to escalate. The other difference is that this happened in Qatar. Qatar is a country that is has the best relations with Iran of any Arab Gulf state. And I think Qatari officials are furious that this has happened. This undermines their image as a stable island in a troubled region. And so although I wouldn't expect them to respond very strongly or with military action, I think, we don't know exactly how the Qataris will take this. But the hope is certainly there that this could be the start of a de-escalatory cycle that leads to a winding down of this conflict.
Will, how successful were those American strikes over the weekend of these nuclear facilities? I mean, did we destroy those facilities and that enriched uranium? What's our line of sight there?
It's extremely difficult to know without having ground access to these sites. The Fordow enrichment facility is deep under a mountain, and there's only so much that we can see from satellite imagery. So without having international inspectors on the ground there to report back their findings, it's going to be really difficult for us to find out. And actually, Iran has already taken steps to end their cooperation with the IAEA, the International Nuclear Watchdog. This is one of the steps they've taken in retaliation. And so it could be some time until we know how decisive these strikes were. But I think what is clear is that all three of the facilities did suffer severe damage and has certainly set back Iran's nuclear program, if not completely destroyed it.
Will, do you believe the regime survives this?
At the moment, I think it looks like it probably does in the short term, at least. I've not seen serious signs of a grassroots uprising against the regime that could topple it. But let's remember that the supreme leader is 86. He is reportedly not in great health. And so a leadership succession was likely to happen in the coming years anyway. And I think then when we do see a new leader, they could decide to take Iran in quite a different direction.
Well, thank you so much for your time today. Great insight. Appreciate it.
Thank you.
And Tom Hayes still here with me. Thoughts on all this, Tom, as we're counting down to the close here?
Yeah, well, first and foremost, every time there's a conflict in the Middle East, everyone's worried about closing the Strait of Hormuz. It's never happened. Not even
Which is remarkable, by the way, that it has never happened. It's never closed.
Markets climb a wall of worry. Yeah. You know, I looked at the most recent Bank of America Global Fund Manager survey, the sophisticated, $500 billion, 222 managers. They are still nearly as pessimistic as they were during the COVID lows, nearly as pessimistic as they were during the great financial crisis. I mean,
those are the pros. What about the retail investors?
Well, look, retail investors, oddly enough, have been right since COVID. They've been buying all the dips when the institutions have been hiding under the table, and they've been making all the money. And I think that trend is going to persist. With sentiment like this, markets don't top when sentiment is that pessimistic. And that's why I think we're going to push to new highs before the end of the summer. Then we'll probably get into some fall normal chop, normal volatility before the end of the year rally. But it's earnings driven. I love they brought the bar down low for Q2 earnings, 4.9%, easy to step over. You don't even have to jump. Market's going to like that. Global liquidity, M2 money supply, 15 central bank cuts around the world. Fed, by the way, now a little bit of dissension. 3, Bowman, Goolsbee, Waller looking for cuts instead of remaining too restrictive like Powell has been talking about. They probably lay that out in Jackson Hole. So what's not to love? There's a lot of good things. Look, we just went through the end of the world tariff war. We just went through the end of the world, a possible World War III type of situation. And these companies keep chugging along. GDP now estimates.
What worries you? What would be on your list of worries on your radar? Downside risks.
Downside risk would be if President Trump didn't like how quickly the tariff negotiations were going, and he did the hard stop on July 9th, and we're back to where we were in April. The probability is that very, very low. We've got an election coming up in next year. I don't think he's going to do that. He'll threaten it, so you'll have a little bit of volatility on the way up. But on balance, it's continues to be time to be constructive, but selectively constructive. And that is, I think, which Ed Yardeni referenced, is the unmagnificent 493 trading at 18 times. There's a tremendous amount of opportunity and underexposure in those stocks.
Stay selectively constructive.
That's right.
Line. Thank you, Tom. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. That is the closing bell on Wall Street, and now it's Market Domination Overtime. Jared Blickery and Tom Hayes with us to get you up to speed on the action from today's trade. Jared, what's the sector action like today?
Well, let's check that out. It's been quite the reversal, and I'll pull up the Wi-Fi Interactive before me, and we can see in the indices we are having the best day in a couple of weeks. Did not expect that when the morning began here. We tended to be in the red for most of these sectors. Here's energy down 2.5% still. That's on a crude oil reversal, but everything else in the green here. XLY, that's consumer discretionary, that's up almost 2%, and you can thank in part Tesla for that and the robo-taxi announcement. Real estate, industrials, communication services, utilities, financial, staples, tech, materials, all of those up over 1%. And if we take a look at the NASDAQ 100, we can see just a couple red squares. Amazon and Alphabet down. Here's Tesla up 8.23%, just circled it up there. Meta up 2 and almost 0.5%. Microsoft up nearly 2. And we can see a similar dynamic playing out in the Dow here. Just a few red spots. Amgen kind of taking notice to the downside, almost down about 6%. Chevron also down nearly 2%. Not surprising as that's part of the energy trade. But besides that, we're looking at a lot of green here. These are the Dow Industrials, and I just want to leave us real quickly on the transports. Everything you see on the screen here solidly in the green, led by Uber, the largest, up 1.68%. And then percentage-wise, we're seeing car, that's Avis, up about 9%. United Airlines up 3.5%. The list goes on. Back to you guys.
Thank you, Jared. Julie, on the floor of the NYSE, get us up to speed.
Yeah, it was really an interesting session, as we talked a lot about, right? To see what we have seen happen in terms of U.S. strikes on Iran over the weekend, and then Iran hitting Qatar today, even if that attack was telegraphed, to then see stocks close out at the highs of the session is a pretty remarkable turn of events here, as we've been talking about, not just today, but really since Israel's attacks on Iran began. This all has to do with what's going on with the price of oil and the fact that oil flows have not been meaningfully disrupted from Iran, that has seen the price of oil come down, has really then what is one of the main driving factors that has allowed stocks to rise. So we continue to watch oil here. Almost 5 million barrels a day of oil that goes through the Strait of Hormuz, both from Iran and from the other countries in that region. It goes to China. And so there have been a lot of market participants who have also been closely monitoring China's reaction to everything that's been going on. And there has been some rhetoric coming from that nation. But again, nothing to cause a lot of alarm in the markets. And we clearly saw that lack of alarm, to say the least, play out today, Josh.
Thank you, Julie. Thank you. Have a good night. Tom Hayes, Great Hill Capital Chairman and Managing Member, still with me. Thoughts on today's moves? What do you make of it, Tom?
Well, you said selectively constructive. I'll tell you what's really interesting today. Small caps outperform tech, outperform the S&P 500.
What do you make of that?
I make it, it's risk on. People are playing the catch-up trade. You got some short covering today. Record short interest in small caps right now. I think that's going to be a meaningful trade for the second half of this year, as people realize, wait, they sold in the hole. Record $1 trillion of equity sold at the beginning of April. They've continued to have been forced in. Now they're like, the market's gotten away from me. How am I going to catch up on performance? The only way you can catch up is to buy the laggards. So you want to be buying small caps. Certainly some exposure to international, even though international has outperformed. And we're seeing that type of thing on these risk-on days. We're seeing the short covering. The shorts become the first buyers, and then you get this positive, constructive cycle. And if you want some valuation relief, small caps is the place to find it. And mid caps, you started to see flows come into mid caps. So it's really interesting to see that today. I'm paying close attention to that.
Jared, I want to bring you in here. So, and Tom does bring a good point. I'm just looking at the small caps here, tacking on about 0.9%. What do you make of that?
Yeah, let's check that out. The Russell 2000 and also the S&P 600, another measure of small caps, that was leading over the last few weeks, and that was mainly to the upside. Then we took a little tumble, and Russell 2000 was leading to the downside. It operates at a multiple of the typical movements that you see in the S&P 500, so it is definitely risk on today. And I'll tell you another thing. I just want to pull up crude oil real quickly, because I got got an interesting stat for you. This is a price action from Sunday evening when the market opened. We are up 4%, and then we closed the day down 8%. The last time we had a swing that big, up 4, down 8, you'd have to go back to May of 2020, and that was just after crude oil, WTI crude oil, turned it negative and traded all the way down to -40. That was a crazy time. So it just kind of illustrates the incredible move that we've seen today.
All right, thank you to Julie and Jared there. Appreciate it. Markets continue to parse geopolitical tensions, plus here in the U.S., parsing the Fed's mixed signals with yields remaining sticky. Investors may be rethinking what it means to hold U.S. debt and whether USA Inc. is still the world's most reliable brand. Joining us now is Mike Kudzel, Managing Director at PIMCO, to break down what it all means. Mike, it is great to see you. I think, though, Mike, we do have to start with geopolitics, war in the Middle East. Iran does respond. They do retaliate. They do fire missiles at a U.S. base in Qatar. But, Mike, the reaction in the markets, it's green all over the place. What do you make of it?
Thanks for having me. I think if you looked Friday night, if folks told you, exactly what was going to happen, I'm not quite sure this would have been the playbook for Monday afternoon. So, lots of process. Markets taking some comfort in what is a measured response out of Iran, and hopefully nothing more than that. And so here we sit with oil down 8% on the day, as opposed to premium built into it. And markets responding quite favorably. Part of it could also be some of the rhetoric you heard out of the Federal Reserve. A couple members out of the Federal Reserve were a bit more dovish to start the week. So, a couple different, headlines that we need to balance. But certainly markets performed, I think, much better than folks would have anticipated if they would have realized, if they would have known the events that were taking place this weekend.
You mentioned in the Fed there, Mike. So let's bring it back home here, because one discussion debate we have a lot on the show. We ask different economists and strategists. I want to get your thoughts as well, Mike. Is what worries you more here in the next few months, in the back half of the year? Is it inflation, Mike? Is it growth? Walk us through it.
Yeah, okay, so, we have to be humble in trying to predict the future here, especially given the unknowns, including geopolitics, including, the tariffs and inflation. Right now, I think we fall on it that, we're a little bit more worried about a potential slowdown in growth, and that we see just in the, the velocity of the labor market having slowed pretty meaningfully. It could all be normalization, but, certainly with the labor market having, the unemployment rate having gone up about 8/10, the quits rate, the hiring rate, all the velocity really slowing pretty meaningfully. When you slow a $30 trillion economy, there's potential for things to tip over. So started in a pretty good place to start the year. Certainly implementation of policy has been somewhat disruptive, and that has, potentially put, folks in a bit of a pause and a timeout, and that could potentially lead to a more meaningful slowdown in the later half of the year. So that's where we fall out on it. Ultimately, tariffs should be more of a tax and a drag on growth than they should be inflationary. And so we're looking, more on the slowdown as opposed to the potential for long-term inflationary pressures.
It's interesting, though, Mike, because some of the other data, I'm just thinking here of Atlanta Fed GDP. I think last I checked, Mike, it's tracking at around 3.4%. You saw the inflation reports. They've been coming in tame, benign. So is the thesis, Mike, okay, that tariff hit, it's on the way?
It's possible. The tariffs have yet to really, be fully implemented. A lot of front loading took place, and a lot of tariffs have yet to, be fully passed on. Whether or not they're fully passed on at all, or as a Fed member referenced today, maybe they'll be kind of shared amongst different supply chain members and consumers and corporations. And so there is that potential. We right now our forecast is for about a 35% chance of a recession with GDP for the full year, about 0.75% to 1%. So we're not forecasting a recession, certainly forecasting a slowdown. And that slowdown could, potentially then, lead to something a bit more nefarious. Anytime you approach stall speed, there's always that potential, things move a little bit further south.
You mentioned the Fed, Mike. We just heard from Jay Powell last week that it's certainly a Fed that's they don't seem like they're in any rush to cut. On the other hand, you had Waller last week, though, too, and he was sort of suggesting, he was talking to the financial press, and, hey, maybe a cut could come as soon as next month. What are your expectations for the Fed this year?
Yes, so last week we did hear from the chair, and we also got the dot plots. So we saw a committee pretty divided. Obviously, seven members did not think that we would cut at all this year. two members thought one, and then the other half of the committee much more dovish than that. And so I think what we're hearing from is the dovish side of the FOMC to start the week. We do believe that there's potential for a couple cuts this year. We think they're more backloaded, and it really would be the Fed responding to a slowdown in economic data. There's a chance if the economy holds up, and if we're a bit too pessimistic on the economy, the Fed doesn't need to do much of anything. And then there's a chance that if the economy does slow down more meaningfully, the Fed cuts much more aggressively. So we're in the kind of more of a bit of a binary action function. There's potential that the Fed doesn't really do much the rest of the year, or potential the Fed delivers much more than what's priced into markets. And so, therefore you get that kind of probability weighted two cuts, but we kind of put it in two different paths almost.
All right, Mike, thank you so much for joining us today. Appreciate it.
Thanks for having me. Appreciate it.
All right, Tom, back to you. Actually, I want to get your thoughts as well on the Fed, because as I was talking there with Mike, you heard from Powell last week.
Yeah.
And Powell saying, listen, I got to see how this tariff inflation is going to play out.
Yeah.
I got to see who's going to pay for it. Is it going to be Tom and Josh? Is it going to be sellers and producers, or some combination? And the message should be, I'm not in any rush to cut, but I'm curious what you're expecting this year.
Well, I thought they were supposed to be data dependent. It sounds to me like he's being prediction dependent, because he is predicting that inflation is coming in the coming months. And in the meantime, he's 200 basis points too restrictive. And who has to foot that $600 billion of extra interest expense? You and I do as the taxpayer.
Is it your opinion they should be cutting now?
I think they should have gone 25 basis points this month. Obviously, there was no probability of them doing so. But now you start to see some of these people dissent. Okay, three people now in the last few days, Goolsbee, Waller, and Bowman. He's got to move, because we got to refinance, and millennials, which is 72 million people trying to start a family formation, mortgage rates at 7.25%, 7%. It's holding up home builders. They're not risking that you're seeing in building permits. It's time to go. It's much easier if he's right about his predictions, which, by the way, he's got real GDP in the SEP at 1.4. If he believes his own predictions, he should be cutting 50 basis points, not saying, I'm predicting inflation is going to go up. It's a one-time tax, just like Mike said. It's time to go. So they'll set the stage. He'll push it off another couple months, and he'll have his meeting in Jackson Hole, and that's when he'll lay it out, and we'll get two cuts, which is Goldilocks, because we don't want more than two cuts, like Mike alluded to, because that implies bad things.
You should be cutting. You have powerful people in your corner, of course, the president, I believe.
I think so.
Around Tom's corner. Thank you, sir.
Thank you.
Well, 2025 proving to be a volatile year for the markets, driven by tariffs, geopolitical tension, and elevated inflation. But amid the economic uncertainty are long-term opportunities, particularly in auto retailers. We're navigating how to play the space with the Yahoo Finance Playbook. And joining us now is Brian McCauley, co-portfolio manager of the Hennessy Focus Fund at Hennessy Funds. The firm has more than $4 billion in assets under management. Welcome, sir, to the show. Appreciate you being here.
Yeah, pleasure to be here.
First question, Brian, I have for you is, when you are screening for opportunities right now, I'm just curious, big picture, you're looking for hunting for opportunities. What makes the screen? Just broadly, what are you screening for?
So we are a very long-term oriented investment firm. Our average hold period is about 7 or 8 years. And so what we're looking for is really businesses that have a sustainable competitive advantage to what they're doing, a large growth opportunity, and we want them to be very well run, because management's going to make a big difference to our investment results over the course of 7 or 8 years. Finally, if we could find those ingredients, we want to pay a reasonable price for that opportunity.
So let's talk about some picks, Brian. What made this screen? One is CarMax. How come? Walk us through that thesis.
Well, the auto space in general we like, because it is a large and permanent part of the economy. And there are pockets where we see opportunity. CarMax is one such opportunity. CarMax, as you probably know, is the largest used car retailer in the country. They have a lot of resources to bring to bear. They provide a great consumer offer. But what we like about CarMax is the used car industry is at cyclical lows now, because prices are so high, there are fewer transactions. And as a retailer, CarMax will benefit as the industry rebounds. Additionally, they've been on a heavy investment cycle, trying to stand up an omni-channel retailing opportunity where you can buy a car online, at a store, or any blend in between that suits you. And they're just concluding the important part of that investment cycle now. We think that as consumers become more familiar with that offering, it'll give CarMax the opportunity to gain a significant market share over the next several years.
CarMax is one. I'm also interested in O'Reilly and why you think that's a smart investment.
Yeah, O'Reilly, quite a bit different business than CarMax. You know, CarMax, I would say, is cyclical for sure. O'Reilly, much more acyclical. You know, they're selling replacement and repair parts to keep your vehicle on the road and running. And so very different economic characteristics to the business. What we like about O'Reilly is, again, an industry leader here. We think they built a better mousetrap, and that over not just a few years, but over several past decades has allowed them to consistently gain market share as they displace other aftermarket auto parts distributors that are not as efficient, that can't provide as good customer service, that cannot provide as high fill rates as O'Reilly can. And so it's just a story of consistent market share gains, rinse and repeat what they've done for a long time now, and they've got plenty of runway in front of them to keep doing it. What we also like about O'Reilly is that, you know, we were concerned about the rise of electric vehicles for many years. Electric vehicles are probably not a good thing for an aftermarket auto parts company that's selling replacement parts for internal combustion engines. But we think that where the US is going is we're going to end up with plug-in hybrids. So it's not going to be a pure internal combustion, nor is it going to be pure EV. It's going to be a blend. So that means there's two different propulsion systems in that vehicle requiring more parts, more replacement, more business opportunities for O'Reilly.
I'm interested, Brian, what's interesting to me, not only what you like, but I'm also curious what you don't like.
Yeah.
Why would you say Carvana is one that viewers should avoid?
Yeah, I think Carvana is a good contrast with CarMax. You know, they're both auto retailers. They are both proposing a friendly customer experience, wide selection. There's a lot to like about the Carvana value proposition to consumers. What we have problems with is simply the valuation. You know, Carvana is roughly a $45 billion market cap today. CarMax, in contrast, is about a $10 billion market cap. So Carvana, according to the market, is worth 4.5 CarMaxes. And yet, CarMax has sales that are nearly 50% higher than Carvana does. And so we just think that it's priced for perfection, and they're not going to be able to deliver on that promise.
Fine, before I let you go, Brian, I want to get your thoughts on switching gears, another name, the Markel Group, which I like, the baby Berkshire Hathaway. Explain that one to me.
Yeah. Well, you know, Berkshire Hathaway, obviously a business that all investors look up to and admire. Markel as well. A couple decades ago, when the family that founded and ran Markel was trying to decide who they wanted to be when they grew up, they looked to Berkshire. And they said, Berkshire's doing a lot of things the right way, and so we want to emulate them. And so Markel is primarily an insurance company, like Berkshire is has large insurance operations. But Markel also has a large public investment portfolio of equities. And the last decade or so, they've been very focused on wholly owned private companies. And so it begins to look very much like Berkshire in its structure. Markel has a great history of compounding, but they've lost their way a little bit the last 5 years or so, and that compounding has slowed down quite a bit. What we like about the stock here is that we think that DNA that led to great historical success is still in place, and they need to make some modifications to some of their management orientation and incentive system, which they're doing, which will enable them to reinvigorate that insurance business that's a large part of their operation.
Brian, great to have you on the show today. Thanks so much for your time and those picks.
Yeah, great. Thank you.
Tom, you were listening closely. You're a portfolio manager. You've got to decide what to buy and what to sell. What did you make of what you heard there?
I liked what Brian said. Brian, what do you think is going to turn around the volumes at CarMax? Is this just an interest rate play? Because you choose industry leaders. I do turnarounds. My name is Turnaround Tom. So we'll talk about advanced auto parts outside. I'm sure you have a lot to say about that. But Shane O'Kelly, we're making a bet on Shane. We're going to have our little niche business just with the markets where we're 1 and 2 because O'Reilly's decimated us everywhere else. But is that how you think about CarMax? Because the average car on the road is 13.5 years. The volume should be booming, right? I mean, and you're also hedged because if people are going to drive it to 15 years, you're going to get the O'Reilly business. But what moves the needle on that one?
Well, as you're familiar, you know, the transaction volumes in both used cars and new cars have been slowed by the high retail prices.
Yeah.
It's more difficult to afford a vehicle today than it was, say, 5 years ago. And so naturally, the industry slowed. People are holding on to their existing vehicles longer. They're going through more repair cycles to try to keep them on the road. Eventually, I mean, you could look back over 30, 40, 50 years of history, you'll see that the used car transactions in this country have been about 40 million per year.
Yeah.
Today, we're sitting about 35, 36 million. Yeah. And so this is the lowest point we've seen in more than 20 years. And so we think it will take time, it will take years, but we think it's virtually certain that we're going to rebound to roughly 40 million unit transaction volume over time. Yeah. And so we can take that to the bank at CarMax. Really, it should benefit a lot of auto retailers. But the company-specific opportunity we see here is CarMax has lost a bit of its luster.
Yeah.
It is not as exciting a place to buy a vehicle today as, say, Carvana is. Mm-hmm. Carvana has that pizzazz to them, great marketing, well-run business. CarMax, as the incumbent, was caught a little bit flat-footed when Carvana came to market. It's taken them time, probably more time than we would like, but we think that now is the point where they're going to begin to claw their way back in, become top of mind for consumers as they roll out these new capabilities and have actually a pretty interesting new advertising campaign come the end of the summer.
Sounds great.
All right, Brian, thanks so much. A lot of good ideas for viewers there. Thank you, sir.
Thank you.
Well, Fred Smith, the man who made next-day delivery possible, leaves a long legacy. Fred Smith, the founder of FedEx, who helped develop overnight delivery, ultimately changing the way business and consumers buy and ship their purchases, is dead at 80 years old. He not only revolutionized shipping, but reshaped global commerce and turned FedEx into a multi-billion-dollar powerhouse. Now, what do those accomplishments mean for the future of FedEx? Julie Hyman recently visited the company's Memphis headquarters and joined us now to discuss. Julie.
Yeah, it was really fascinating, Josh, being there in Memphis and seeing firsthand in a very concrete way what Fred Smith built. That Memphis hub, just planes in and out, and effectively a city, a transportation city that has been built there in Memphis. But when he started out back in 1971, when he started sort of forming the company and then flying the first flights in 1973, maybe he foresaw what he was going to create, but it might have been difficult at that time. He bought 20 business jets and converted them to carry freight. And on that first day that they flew those jets in 73, they made 186 deliveries. Now they make around 15 million a day. So obviously the scale has changed considerably. By the way, Smith was still the executive chairman of the company at age 80 and owned an estimated 8% or so of the shares still. The company did come out and say that Brad Martin is going to be the chairman to replace Fred Smith right now. He had been the vice chairman of the board. And I also had the chance to speak with Raj Subramanian, who is now the CEO of the company, really a protege of Fred Smith. Subramanian has been at FedEx his entire career and moved up through the ranks before being handpicked by Smith to be his successor several years ago. And he has really brought a lot of change to the company. The company is about to report earnings tomorrow after the close of trading. And it has been a time that has been challenging for FedEx, in part because of tariffs and the effect that that has had on global flows, and also just changes to the business that he has made. A little bit of context here, FedEx down 19% year to date. If you look at the estimates for earnings, this will be their fiscal fourth quarter. The EPS forecast to rise 8% to $5.86, and then revenue to fall 1% to $21.78 billion. So those are the numbers we will be looking for tomorrow. We'll have much more market domination overtime after this.
Tesla shares ride higher after the EV maker's launch of its robo-taxi service in Austin. The company starting off with 10 to 20 Model Y SUVs running as robo-taxis in a geofenced area of Texas. For more on what this all means for Tesla and the road ahead, let's welcome in here TD Cowen equity analyst Itai Michaeli. Itai, it is good to see you. So over the weekend, Itai, I did see Dan Iser at Wedbush. Now we know Dan, Tesla bull of bulls, of course. He attended this event. Here's what he said. He even took some rides, Itai. He gave us the summary. He gave us the after-action report. He said, these robo-taxis exceed our expectations and offered a seamless and personalized travel experience that has lit the spark for autonomous driving. Is that how you see it, Itai? Has it lit the spark?
Oh, thank you for having me. Day one does seem like it was successful. There were two aspects of the launch that were better than what we would have expected coming in. The first is where the vehicles actually operated, or the operational design domain, was larger than what we would have expected. And some of the pickup and drop-off activity looked pretty impressive for a first day in a robo-taxi operation. It's still premature to draw meaningful big-picture conclusions from a single day, but so far a pretty impressive launch, and we'll kind of have to monitor it in the weeks and months ahead.
Itai, how quickly and aggressively do you think Musk can expand this service across the country?
I think their strategy of a measured approach is the right one. Safety is paramount. We've seen situations in the past where robo-taxi networks had safety issues, and some of them actually shut down as a result of it. And so we want to first and foremost monitor the safety record, rider, and stakeholder feedback in the weeks and months ahead. Does the operational design domain expand from where they are currently? Does a fleet size expand from here? But going at it slow, particularly given Tesla's lead relative to other car companies in the autonomous vehicle space, does give them some breathing room to move slowly. And so execution around that is key. I think if all goes well, probably in the next few months, investors will be asking what the next city could be. And for us, we're also really watching what ends up happening to the consumer fleet, where there's maybe an overlooked opportunity, frankly, in the Tesla autonomous vehicle story to roll out eyes-off FSD features that could both complement the robo-taxi fleet and lead to new services and features for consumers that can drive up not only new revenue streams for Tesla, but also vehicle demand itself.
In this space, Itai, Musk has plenty of competition. He's got Waymo and Amazon Zoox is in there. And when your clients are asking you what you think his competitive advantages are, what do you tell them?
Sure. Cost is one of them. Speed is another. And the talent they have at Tesla. This is a $1.5 trillion mobility market in the U.S. The rideshare industry today is only about $60 billion. So we still have a lot more to go. And we think Tesla's competitive advantage could really allow them to deploy AVs, both robo-taxis and consumer AV features in less dense MSAs, where today the rideshare market is not particularly highly penetrated. And because of Tesla's cost advantage, because of things like shadow mode validation that they can use from their existing fleet, we think they have an opportunity to launch robo-taxis in markets that are today less penetrated and complement those with consumer vehicles, and also, of course, lead to new features and services as well. Think of the vehicle getting your deliveries in the middle of the night. Think of dropping you off at the movie theater and picking you up later on. Features that you could charge for, and of course, can create an unprecedented proposition for consumer demand across Tesla's vehicles. And we know, of course, demand has been more challenged in recent quarters. So we look at the AV story as very complementary to the overall EV story and demand story at Tesla, but cost and speed really are key advantages they have today.
Itai, before I let you go quickly, of course, if you're a Tesla investor, you're listening right now, you got some other big dates on the calendar, Q2 deliveries, Q2 results. What are you watching for there?
Sure. The next data point will be Q2 deliveries. Some of the data points are still waiting on a few more, have shown some continued pressure thus far in Q2. And of course, the earnings call, we'll expect to see not only the numbers, but I'm sure the next maybe formal update around the next steps of the AV journey, maybe more stats within the Austin deployment. And of course, the road ahead from there, all are going to be closely watched in the weeks ahead.
Itai, great to have you on the show today. Thank you, sir, as always, for your time.
Thank you.
And of course, a big thanks to Thomas Hayes, Great Hill Capital Chairman, Managing Member, for hanging out with me today for the show. Final thoughts on selectively constructive. I like that.
Selectively. Look, if we look at earnings, by Q1 of 2026. Mag 7 is going to decelerate from 27% earnings growth in the first quarter this year to 10.2 in the first quarter next year. Unmagnificent 493 accelerating from negative last year to 10.3% first quarter next year. So you're paying lower multiple for more earnings growth in the 493. You're paying a higher multiple for declining earnings growth in the Mag 7. There's a lot of opportunities. You just got to look under the surface. And as we saw today, never bet against America.
Look under the hood. Tom, we'll leave it there. Thank you, sir. Appreciate it. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow, 3 p.m. Eastern for